Welcome back to Talk Tickers. This is our special deep dive where we take, these massive corporate earnings calls and just break them down for the everyday retail investor.
Right, yeah. No jargon, just the numbers that actually matter.
Exactly. And today, we've got a fascinating one. We are looking at the Q2 2026 earnings call for Aebi Schmidt. Ticker is AEBI.
Aebi Schmidt, yeah.
And our mission today is to figure out how this heavy manufacturing company, imagine this, a company that was bleeding almost $8 million just a year ago, how they violently swung that to a $10.5 million net profit in just 12 months.
It's a massive turnaround. It really is.
Yeah, an $18 million swing on the bottom line. So we're skipping the boring executive summaries today. We're going straight to the factory floor. Right? We want to look at, production lines, how they're handling recent acquisitions, and honestly, how geopolitical shocks are messing with their margins.
Yeah, because it's not all sunshine, right? But this transformation on the balance sheet, it's striking. And it's striking because it's not just some accounting trick.
Right. No smoke and mirrors.
Exactly. No one-off asset sales. When you look at the raw data, this turnaround was driven just entirely by operational execution. Right there on the factory floor.
So let's unpack that. Did they deliver? Give me the headline numbers.
Okay, so they reported $496 million in net sales for the quarter.
Okay, almost $500 million.
Yeah, $500 million top line. And that represents a 9.4% increase year over year. But here's the crucial part. Management was very quick to clarify that this 9.4%, it is entirely organic growth.
Okay, and we should clarify that for people, right? Because that distinction, organic growth, that's where the real health of a business shows up.
Oh, absolutely.
Because, we know they acquired the Shyft Group, right?
Right.
And obviously, when you buy another company, your total revenue gets artificially inflated.
Right, you're just bolting on their sales to yours.
Exactly. But carving out that 9.4% organic figure, that basically proves that their core engines, their legacy street sweepers, their standard walk-in vans, they are capturing market share entirely on their own merit.
Yeah, they're not just buying growth.
Right. The demand for the stuff they inherently build is accelerating, completely independent of their M&A activity.
Exactly. It proves the base business isn't just, stagnating while management distracts themselves with integration.
Yeah, which happens so often.
Right. But honestly, the top line revenue is, it's really only half the story here.
Okay, so what's the flow through look like?
The flow through to profitability is where the mechanics get really interesting. So in Q2 of 2025, right, a year ago, they posted a net loss of $7.9 million.
Ouch. Yeah.
Yeah. But this quarter, they posted a net income profit of $10.5 million.
That is just wild.
And if we look at their adjusted EBITDA, which is, their core operating profit, before you get all the noise of interest and depreciation in there, they hit $42.1 million.
Wait, 42.1?
Yeah, $42.1 million. That is a 22% jump year over year.
Okay, wait. I'm looking at that exact ratio in my head right now, and that math tells a very specific story, doesn't it?
It really does.
Because they grew sales by 9.4%, but their operating profit jumped by 22%.
Right.
So their profit is growing at, more than double the rate of their revenue?
Yeah, exactly.
We are looking at massive operating leverage kicking in here. Are they just selling more stuff, or are they selling it smarter? Based on their factory footprint, how is that leverage actually translating?
Well, it comes down to fixed cost dilution.
Okay, explain that.
So heavy manufacturing, right? Building specialty vehicles, snow plows, massive street sweepers, that requires immense fixed overhead.
Oh, for sure.
You have to pay for the factory heating, the administrative staff, the depreciation on all that heavy machinery.
The union wages.
Exactly, the base union wages. And you pay all of that regardless of whether you push 10 vehicles off the line or 100 vehicles.
Right, the lights cost the same to keep on.
Exactly. So what we're seeing in this 22% EBITDA jump is the tipping point of capacity utilization.
Okay.
As they push that extra 9.4% of organic volume through those exact same factories, the fixed overhead assigned to each individual vehicle just plummets.
Oh, I see.
Yeah. So every incremental van they produce becomes significantly more profitable than the one right before it.
That makes so much sense. They clawed back 19 basis points on their margin too, right?
Yeah, bringing it to 8.5%.
Which, 19 basis points. If you're talking about software, a 19 basis point margin improvement is a rounding error. Nobody cares.
Right.
But in heavy industrial manufacturing, where your margins are just notoriously getting crushed by raw material costs.
It's huge.
Yeah, expanding your margin by 19 basis points while dealing with global inflation, that's a massive signal of efficiency on the factory floor.
It is the defining metric of a healthy industrial operation. And when we look at the specific drivers behind this volume increase, management pointed directly to North America.
Okay, what's happening there?
They saw an 11% spike in net sales just in that region alone.
Wow.
Yeah. And they attributed explicitly to walk-in van backlog conversion, mainly following the ramp-up of their Joliet production facility.
Okay, let's dissect that backlog conversion, because an 11% regional sales spike, that isn't just new daily demand materializing out of thin air, right?
No, not at all.
Because we know the entire automotive sector has just been choked by supply chain bottlenecks for, the better part of 3 years now.
Oh yeah, it's been a mess.
They've had these customers just sitting on orders, waiting for chassis and microchips. So this spike, it kind of implies that the dam has finally broken in Joliet.
The dam is breaking, yeah. And the Joliet facility is essentially the pressure valve. Aebi Schmidt has been sitting on this mountain of unfulfilled orders. Like, their total backlog right now is sitting at $1.279 billion.
A billion. Wait, 1.27 billion with a B?
With a B, yeah.
Yeah.
Over $1.2 billion in backlog.
That is insane.
It's massive. And for quarters, they simply could not sort the ingredients required to build the vehicles they had already sold.
Right.
So this Joliet ramp-up, it signifies that the localized supply chain for walk-in vans has finally stabilized enough for them to dramatically increase their daily throughput.
So they're finally taking those legacy orders, marrying the bodies to the chassis, delivering the units to the fleets.
Exactly. And crucially, they're finally recognizing that revenue on the income statement.
Okay, so they're just chewing through the ticket rail right now.
Yeah, they really are.
But clearing old inventory only gets you so far, I want to shift to the second major driver of that 22% EBITDA jump, because we have to talk about the Shyft Group acquisition.
Oh, definitely.
So it's the 1-year anniversary of the deal, right? And I was looking at the original projections. Management originally projected a synergy run rate of $25 to $30 million when they bought them.
Right.
But on this call, they updated that target. They bumped it to over $40 million.
Yeah, they did.
And I've got to say, finding an extra $10 to $15 million in structural savings post-merger, that is highly unusual.
It really is. Usually you see those numbers get revised down.
Exactly. So how are they executing this integration to extract that much excess value? Like, are we just looking at aggressive headcount reductions, or is there a mechanical shift in how they build things?
It is deeply mechanical. Honestly, it's a masterclass in vertical integration.
Okay, break that down for me.
So the classic M&A playbook, like you said, it usually relies on slashing administrative redundancies, firing middle management, that sort of thing.
Right.
But Aebi Schmidt is extracting this value directly out of the bill of materials. The prime example they highlighted on the call was the XP service body PRO.
The XP service body, what is that exactly?
It's basically the complex, customized rear compartments of these specific work trucks.
Oh, okay.
Prior to the merger, manufacturing those bodies was likely outsourced or handled through these really fragmented, inefficient supplier channels.
Gotcha.
So what Aebi Schmidt did is they took that entire proprietary manufacturing process and they just brought it entirely in-house.
So they essentially fired the middleman.
Yes, exactly.
And they absorbed the supplier's profit margin directly into their own EBITDA.
That's it perfectly. When you vertically integrate the manufacturing of a core component like a service body, you aren't just saving the markup.
What else are you saving?
You're taking absolute control of the quality assurance. You're eliminating the freight costs of shipping massive metal components between third-party facilities.
Oh, that makes sense. Shipping heavy metal is not cheap.
No, it's incredibly expensive. And you're also synchronizing the production timeline. So the chassis isn't just sitting idle on your floor waiting for a let part to arrive from a supplier.
Right, tying up space and capital.
Exactly. And that level of operational control, that is how you revise a synergy target upward by $15 million.
Wow. And it isn't just cost extraction either, because I'm looking at their cross-selling metrics, and this is super interesting.
Yeah.
They are taking Elido, which is their European municipal vehicle brand, and they are pushing those units into their established North American airport customer base.
Yes.
So they're taking a mature European asset and dropping it directly into Shyft's domestic distribution network here in the U.S.
Right.
the customer acquisition cost on those Elido sales essentially drops to zero, right?
Really, yeah.
Because the sales rep is literally just adding a line item to an existing municipal contract. They're already talking to the airport about vans. They just say, hey, I want a sweeper too.
Exactly. That cross-pollination is the exact strategic rationale for cross-border M&A. Yeah. And they expect to have 37 million of these total synergies fully realized on the balance sheet by the end of 2026.
Okay.
With the final tail, coming online in 2027. So when you combine the internal margin capture of things like that XP service body with the essentially zero CAC cross-selling of European units,
it all adds up.
Yeah, you begin to understand the architecture of that $18 million net income turnaround.
It really paints a picture of a company aggressively executing on what they can actually control.
Right.
And the sales data backs up the strategy too, because they just announced this $96 million 7-year framework contract in the US, right?
Yeah, I saw that with a legacy partner.
Yeah, a client they've had for over 2 decades. But the critical detail in this filing, it's not the dollar amount, it's the scope of the deal.
Okay, how so?
Because for the very first time, this legacy walk-in van customer is also buying cargo vans from Aebi Schmidt.
Oh, wow. That scope expansion completely changes the valuation multiple you can assign to their customer relationships.
Because they're doing more for the same client.
Exactly. Aebi Schmidt is transitioning from just a specialized vendor to a comprehensive fleet solutions provider.
Right.
When a major logistics company decides to unify their walk-in van and their cargo van procurement under a single supplier, it creates massive operational stickiness.
Stickiness is the word, yeah.
The client gets to simplify their maintenance protocols, their procurement bureaucracy, and in return, Aebi Schmidt locks in a 7-year revenue stream that competitors will find nearly impossible to disrupt.
Yeah, trying to untangle that as a competitor would be a nightmare. And they also secured an $11 million German motorway contract on the European municipal side too, right?
You did, yeah.
So, okay, the bull case is very clear here. We've got a $1.2 billion backlog converting into cash. We've got a highly accretive M&A integration, and we've got multi-year, multi-vehicle contract wins.
It looks great on paper.
Right. But, and this is what we do here on Talk Tickers, we need to pressure test the vulnerability.
Always.
Because it can't all be sunshine. And despite this record execution, their CFO, Marco Portman, he's been a pretty significant portion of the call managing expectations around gross margins.
He did, yeah.
We know the macroeconomic environment is hostile. The primary headwind they explicitly cited on the call is geopolitical instability, and they pointed directly to the Iran war. Now, I need you to explain this to me. If they are building vans in Joliet, Illinois, and sweepers in Germany, map the exact supply chain mechanics for me. How does a conflict in the Middle East actually compress Aebi Schmidt's gross margin in Illinois?
It is a direct, unavoidable transmission mechanism through the energy markets.
Energy, okay.
Yeah, heavy industrial manufacturing is entirely beholden to the cost of electricity and natural gas.
Right.
When geopolitical conflict threatens energy-producing regions, global energy futures spike immediately. And Aebi Schmidt doesn't just consume energy to run the stamping presses in Joliet.
They're buying raw materials.
Exactly. They are buying thousands of tons of steel and aluminum, and the smelting processes for those raw materials. They are among the most energy-intensive industrial activities on Earth.
Oh, I hadn't thought about that. The steel foundries themselves are getting hit.
Yes. When the steel foundries see their energy bills spike, they immediately implement raw material surcharges to their buyers.
Okay, so the cost gets passed down the chain.
Exactly. Portman explicitly noted on the call that they are absorbing material cost inflation passed down from suppliers who are reacting to these energy shocks.
That makes total sense. And on top of raw material inflation, they're also navigating renewed discussions around international trade tariffs right now.
Which is a whole other headache.
Yeah.
Oh.
A sudden tariff on imported specialty components can basically wipe out the profit margin on a highly engineered vehicle before it ever leaves the factory floor.
Absolutely.
So if I'm running this company, the obvious corporate response to raw material inflation and tariff risk is dynamic pricing.
Right.
If the steel costs me more today, well, you charge the municipality more for the street sweeper tomorrow.
Right.
You'd think so.
But they are still forecasting margin pressure. So what is preventing them from just passing this exact cost directly to the end user? Why are they eating it?
Well, this is the double-edged sword of operating with a $1.279 billion order backlog. Yeah. Management absolutely did raise prices. They executed swift sales price increases across their entire portfolio.
But the mechanics, of a municipal or fleet backlog create a severe time lag.
The delay.
A massive portion of the vehicles they are assembling right now in Q2 of 2026 were ordered, negotiated, and legally contracted in late 2024 or early 2025.
Wow. Okay. It's the ultimate pricing paradox.
Yes.
It's like a caterer who locked in a contract to serve 1,000 meals at, say, $50 a plate, right? A year in advance.
That's a great analogy, yeah.
And then when the event finally rolls around, the wholesale cost of beef has tripled. You are legally obligated to serve the beef at that event, but your margin on that specific plate is absolutely decimated.
That is exactly what is happening on their assembly line right now.
Wow.
In Q2 2026, they are buying steel at inflated, geopolitically stressed prices, and they're using that expensive steel to fulfill a legacy 2025 contract at a fixed lower price point.
And they can't change it.
No, they cannot retroactively apply their 2026 price hikes to the $1 billion of old orders sitting in the queue.
So that means the margin weakness we might see in the next few quarters is structurally baked in.
It is.
The aggressive price hikes they initiated recently, those are only attaching to the new orders entering the back of the line today.
Exactly.
Given the size of this backlog, when do those margin-correcting prices actually start flowing through the income statement? When do we see them?
Well, based on their current throughput, they have production visibility stretching well into 2027.
Okay.
So that means the higher margin contracts won't meaningfully dominate the balance sheet until probably late 2026 or early 2027.
That's a long time to wait.
It is.
Yeah.
Until that legacy backlog is cleared, management is entirely reliant on those M&A synergies we talked about.
Right.
And ruthless cost controls to defend the bottom line against the raw material inflation.
Okay, that dynamic is critical for evaluating their guidance. Because despite that margin squeeze from the legacy contracts and despite the energy market volatility, they actually confirmed their full year 2026 guidance on this call.
They did, yeah. They stood by their numbers.
They are projecting sales between $1.95 billion and $2.15 billion and an adjusted EBITDA between $175 million and $195 million. They aren't backing down at all.
No, they're confident.
And furthermore, they updated their Group Strategy 2030 target.
Oh, yes.
They are targeting $3 billion in annual sales and an adjusted EBITDA margin above 13% by 2030.
Which is aggressive.
Very. Because going from an 8.5% margin today to over 13% in 4 years, that requires a monumental leap in operational efficiency.
It requires flawless execution.
Yeah.
To expand margins by 450 basis points in a heavy manufacturing environment, you have to optimize every single square foot of your manufacturing footprint.
Right.
You have to aggressively scale your high-margin aftermarket services, and you have to maintain absolute pricing discipline as that legacy backlog clears. It is a highly aggressive target that basically assumes the geopolitical shocks will eventually stabilize.
So let's look at how they're managing their balance sheet to survive those shocks in the interim. Because they reported a net debt of $450 million. And their leverage ratio, which for the listeners is just net debt divided by adjusted EBITDA, that sits at 2.72x.
Right.
Now, that is a vast improvement from 3.28x a year ago. They are clearly generating enough cash to delever the business.
They are.
But they made a very specific, almost counterintuitive tweak to their year-end guidance on this call.
The leverage tweak.
Yeah. They previously told the market they would get that leverage ratio to 2x or slightly below by the end of 2026.
Right.
But now they have revised that exact target to 2x or slightly above. They are actively planning to carry slightly more debt relative to their earnings than initially promised. Why on earth would they do that?
Right. So in a standard quarterly earnings cycle, walking back a debt reduction target immediately triggers analyst anxiety.
Oh, Wall Street hates that.
They despise it. It usually signals that cash flow is deteriorating or capital expenditures are just spiraling out of control.
But that's not what's happening here.
No. CFO Marco Portman preempted that concern with a very clear strategic rationale. They are intentionally tying up cash in inventory. They're actively buying raw materials and critical components in larger batches and aggressively increasing their safety stock on the factory floor.
So they're essentially stuffing the pantry.
Exactly.
They're looking at the tariff threats and the energy volatility, and they are choosing to sacrifice the short-term optics of a pristine leverage ratio to guarantee supply chain continuity.
It is a direct repudiation of the just-in-time manufacturing model.
Which failed so spectacularly during the pandemic.
Spectacularly, yeah. In a volatile geopolitical environment, Running lean on inventory is a catastrophic risk.
Oh, for sure.
Think about it. If an energy shock or a sudden tariff temporarily chokes off the supply of, say, specialized aluminum extrusions, a competitor who is running a just-in-time model has to idle their entire factory.
And with a $1.3 billion backlog waiting to be converted into cash, idling the Joliet facility because they ran out of a specific bracket is the absolute worst-case scenario.
Exactly.
The revenue is guaranteed. The only risk to this company right now is their inability to physically build the unit.
Precisely.
Oh.
By intentionally stuffing the pantry, they are insulating their production schedule from all those external shocks.
So smart.
Yeah. Holding excess inventory does tie up working capital, and it does slightly elevate that net debt calculation. But it guarantees they can keep pushing vehicles off the line.
Right.
Furthermore, buying in massive batches allows them to lock in volume discounts.
Oh, right.
Which acts as a secondary hedge against that raw material inflation we discussed earlier.
What's fascinating to me is that even while intentionally holding this heavy inventory, their overall efficiency is actually improving.
The working capital ratio,
Yeah, I'm looking at it right now. Their working capital ratio, which basically measures how tightly they manage their cash and inventory relative to total sales, it actually improved from 25% a year ago down to 23% this quarter.
That's incredible.
They are executing a structurally leaner operation while simultaneously building strategic stockpiles. Like, how do you even do that?
It demonstrates a highly sophisticated approach to capital allocation. They are managing the business for structural long-term resilience, not just to appease a Wall Street algorithm demanding lower debt metrics for this specific quarter.
Which forces us to really look at the bottom line here. I mean, we've dissected the headline turnaround. We've gone over the $40 million synergy mechanics, the geopolitical margin squeeze, and their defensive inventory posturing.
We've covered a lot.
Yeah, so taking all of this data into account, where does this leave the everyday retail investor who's sitting at home analyzing AEBI?
The underlying data points to a decidedly bullish signal for the long-term investor.
Okay, so you're bullish.
I am. The immediate macroeconomic fears are real, but Aebi Schmidt has built a structural fortress to withstand them. That $1.3 billion backlog, it provides absolute revenue visibility well into 2027. We do not have to speculate about consumer demand next quarter. The municipalities and the fleet operators, they have already signed the contracts.
The check is basically in the mail.
Exactly. The singular mandate for management right now is just execution.
Yep.
And the Joliet ramp-up, combined with the over-delivering Shyft synergies, it proves their execution is currently peaking.
And they are actively expanding the ecosystem around those vehicles, too, because I want to mention they highlighted the rollout of their Atlas Care service network across North America.
Oh, right, with Love Travel Stops.
Yeah. This fundamentally alters their business model, I think, because they are transitioning from just a point-of-sale equipment manufacturer to a lifecycle service partner.
It's a huge shift.
And the aftermarket parts and service business, it carries vastly higher margins than the initial vehicle sale.
Oh, always.
So if a logistics fleet knows they can get an Aebi Schmidt van service at a nationwide network of travel stops, I mean, the stickiness of that client relationship becomes heavily entrenched.
It's a brilliant margin expansion play, and it directly supports their 2030 target of a 13% EBITDA margin.
Yeah, it really does.
There is one massive industry shift that was addressed during the Q&A that we need to evaluate, though.
Oh, the Ford thing.
Yes, the Ford situation. An analyst brought up Ford's decision to transition a significant portion of their walk-in van chassis production over to Bluebird.
Okay, explain why that matters to Aebi Schmidt.
So Aebi Schmidt is an upfitter, right? They build the specialized body, the box on the back, but they rely entirely on OEMs like Ford to provide the underlying engine and the frame.
Gotcha.
When a major supplier completely restructures their production model like this, it introduces profound supply chain risk. Right at the exact moment Aebi Schmidt is finally clearing their backlog.
Oh, that's terrible timing.
It was probably the most critical strategic question of the call. The Ford and Bluebird transition is a tectonic shift for the entire specialty vehicle industry.
But how did management react to it?
CEO Baron Fruthoff framed the disruption as a necessary long-term stabilizer.
Wait, a stabilizer. How is a disruption a stabilizer?
Well, the subtext here is the looming EPA 27 emissions regulations.
Ah, the EPA.
Yeah. The industry was facing a massive potential supply gap as older chassis designs struggled to meet the new certification standards for 2027.
Oh, I see.
So by partnering with Blue Bird, Ford is effectively guaranteeing that a compliant, high-volume chassis will remain available in the market.
So the short-term friction of a production shift right now is basically just the price they pay to ensure the raw materials actually exist in 2027.
Exactly. Fruthoff also emphasized the strategic importance of dual sourcing on the call.
What's that?
By actively managing relationships with both the Ford and Blue Bird Alliance and FCCC, which is Freightliner Custom Chassis Corporation.
Okay.
Aebi Schmidt is actively preventing a supplier monopoly. If Ford hits a production snag during this transition, Aebi Schmidt is already shifting client orders toward the FCCC chassis.
Oh, that's smart.
Yeah, maintaining two robust, competitive chassis suppliers, it gives upfitters ultimate leverage in pricing and availability.
That agility in the supply chain is exactly why they are confident enough to, stuff the pantry and forecast a $3 billion top line by 2030.
Right.
The mechanics of this business are firing on all cylinders, insulated by a historic backlog and a highly disciplined integration strategy.
It's a very strong position to be in.
But as we close out this deep dive, there is one data point that I think demands deeper scrutiny for anyone looking at AEBI as a multi-year hold.
Okay, lay it on me.
Aebi Schmidt is currently generating record profits, and they're expanding margins by violently chewing through this $1.3 billion backlog, right?
Yes.
But that mountain of orders is a historical anomaly.
It is.
It was generated by the catastrophic once-in-a-generation supply chain paralysis of the pandemic, where customers were basically forced to double order and wait years for delivery just to get anything.
Exactly. The order books got completely distorted.
Right. So the critical question for the long-term health of this stock isn't what happens the next quarter. The question is, what happens in 2028? When the global supply chains finally normalize, when that pandemic-era order queue is completely fleshed out, and they are suddenly forced to feed these massive Joliet factories strictly on new daily organic demand,
Right.
Can they sustain this momentum? Or is this 22% EBITDA jump simply the temporary financial release of a 3-year bottleneck?
That is the question.
That transition from backlog clearing to organic daily sales, that will be the ultimate test of their $3 billion valuation target. And that's something investors need to keep a very close eye on.
Absolutely. You can't just look at the next 12 months.
Exactly. Well, that wraps it up for today's Talk Tickers Deep Dive. As always, keep an eye on the numbers, ignore the noise, and we will catch you on the next one.